The story that was rallying the markets a little bit, or they added to the losses. It's a Financial Times story reporting that the United States is turning down these preparatory talks with lower-ranking trade ministers ahead of the big one with the top-ranking trade ministers and top trade U.S. cabinet officials in this country because they do not feel that the Chinese are making adequate measures or taking adequate measures to deal with what looks like patent infringement, that sort of thing, and spying on companies and stealing their secrets. You've heard this very often, but it has rattled the markets that only yesterday, even though with the close on the Martin Luther King holiday, had been hoping that some sort of progress or announcement would be made. A market watcher, Jeff Saut, on this. Jeff, I'm giving you the bare bones details. The gist is, don't hold your breath for a trade deal.
Yeah, I don't disagree with that. I think it's a mess. I think eventually we will come to a conclusion to this because I think China needs the U.S. more than the U.S. needs China. And I think that the U.S. will actually win in this trade tiff.
All right, what we're arguing about is something that the Chinese don't want included in the talks. That, look, we have said that they steal our technology. They call it technology transfers, that every company that sets up business in China more or less exposes its soul in spreadsheets and have at it. And we wanted some safety and conditions put in place that would stop that from happening. Well, China's always argued it doesn't happen, so I don't know what you're making a big deal of, U.S. We have said unless that is part of this, we're not going to go beyond this. So we're not even going to talk to your, vice ministers or whatever the level is below that. How bad could this get?
It could get really bad. But again, I think that China will lose in this argument, and the U.S. will win because China needs the U.S. more than the U.S. needs China. So I think it'll eventually get worked out. I think that's what the rally was all about. We identified the selling climax, the three-day selling climax that ended on December 24th. We said the market should rally back to 2,600, 2,650. It overshot that level a little bit on Friday on potentially favorable trade news, but we're sticking with our short-term cautionary stance right here, thinking the market's going to pull back.
All right, so we've had a very strong January thus far, and there is market law that says as the market starts the year, it has a good year. This is the strongest start of a year, today notwithstanding, since 1987. Now, that's a separate issue, what happened in 1987 by the end of the year. But what do you think of how this year could sort itself out?
I did a conference call with Ned Davis, to our advisors this morning. Mm-hmm. He thinks that, Ned, I've known Ned since 1973.
Mr. Research.
He thinks the market sinks a low sometime here in the first half of the year, and then you get double-digit returns in the back half of the year, and I do not disagree with that.
All right, now the shutdown, does that come into play? We're in our 32nd day. Doesn't look like we'll have this resolved anytime soon. Cooler heads could prevail. I know Mitch McConnell's talking about voting on what the president offered Democrats later on this week in the Senate, but your thoughts on that and the market impact?
Well, I lived in D.C., and I've never seen D.C. stood on its head the way it's been stood on its head over the past 2 years. I don't think there's going to be a short-term solution to this. Both sides look pretty dug in to me. But eventually that, too, I think will get resolved. And I think the economy's still good. I think earnings are still good. I would pay more attention to the December low indicator than the January barometer, and that December low indicator says if the closing low in December is violated in the first quarter of this year, watch out. And that was proffered by my departed friend, Lucian Hooper.
You know, Jeff, when I look at interest rates today going down as a flight to quality investing, and a 10-year note, for example, moves up, I'm realizing that the gap between short and longer term rates is getting really, really narrow again. That's not always a nightmare. It doesn't always portend problems, but it catches my attention. Does it catch yours?
Well, I think people are looking at the wrong inversion, I should say. In my 48 years in this business, it's always been the 90-day T-bill versus the 30-year Treasury bond, not the 2s to 10s or the 3s to 5s.
And there you have a bit of a wider spread.
Exactly. Right. And it has not inverted, and I don't think it's going to invert.
All right. When it's this now, and we pay a lot of attention even to overnight bank money and a 10-year note, that's a fool's game to be obsessing about that?
I think it is. I think when everybody's asking the same question, it's typically the wrong question, Neil.
You know, that's such a good point. I'm not going to add to it. All right. Very good job, Jeff. Good seeing you again. You calmed me down a little bit.
Always a pleasure.
A little bit, my friend.